Dear clients, I'm Richard, CDF Dealer. Today I will comment on the recent market turbulence that underscored a roller coaster start for 2014 as financial markets contemplate the sustainability of global growth momentum as well as anticipate the directional shift in global monetary policies. To begin, recall from my last commentary when I highlighted that cross-market actions are expressing skepticisms over the global growth optimism exhibited by the equity market euphoria, thereby forewarning an increasing risk of an equity space correction. Indeed, equity market was rattled by several growth scares that materialized, which range from the worst emerging market currencies rout in 5 years to a mixed run of economic data from US and China. Specifically, in the emerging markets, the world witnessed the collapse of Argentina's currencies amid a rash of capital outflow in view of its structural economics imbalance. We also watched Turkey, India, Brazil, and a string of other younger economies being forced to tighten their monetary policies in the face of domestic inflationary pressures and/or capital account weaknesses, which might pose as headwinds for global economic growth. And in the US, job growth in December and January this year were the weakest of any 2-month period in the past 3 years, according to a US Labor Department report. Throw in China's January PMI data points indicating contraction in manufacturing activity, and we got a perfect recipe for a risk-off phase. An equity market correction did ensue, but it ended quite as abruptly as it started. The S&P tumbled 5.8% from its record close on 15th of January through 3rd of February, as VIX, commonly known as the Fear Index, rocketed to 21, a level which historically indicates the potential for a bigger risk-off move. However, this round, I believe, the correction was brief, as market participants are already anticipating reassurance for the continuity of accommodative monetary policy from Janet Yellen, who was sworn in as Fed chairman on 3rd of February. The benchmark equity index trimmed the losses to 2.6%, as the new Fed chairman gave her first congressional testimony on 11th of February. A cautiously optimistic tone was carefully crafted for the markets, and the calmer mood was well reflected in VIX, which dived 33% to 15th from its recent risk-off peak. Sentiment also got a further lift from news that the US debt ceiling can't get kicked down the road till March 2015. Amid the turmoil stirred by the above global events, nice tranquility can still be found in some cross-market spaces. For instance, gold and US Treasuries appeal shine through the storm, as safe haven demand for these alternative assets underpinned their price actions in an almost straight line manner towards the northeast direction. On a concluding note, I've previously guided some key cross-market handles. For instance, a convincing break higher than 1.38 for Euro USD, a sustained rise above 3% for 10-year US Treasury yield, and a return to its long-term downtrend below $1,200 for gold. That should corroborate with a rising equity market. To date, these hurdle levels remain in place, which implies that cross markets are still debating the nuances of the global growth rhetoric for 2014. Hence, meanwhile, barring major policy reversals and/or evidence of accelerating economic growth, I believe equity market upside should be met with stiff resistance near its recent highs. Clients may consider using CDF to trade equities and indexes across markets to capitalize on trading opportunities in both rising and falling markets. In addition, you may also trade based on different strategies using many more benchmarks which are available with Phillip ETFs. Thank you for watching this week's Market Watch. I'm Richard from CDF. Tune in next week for more market video. Thank you.